Hello, I'm Sam Stovall, Chief Investment Strategist of CFRA Research. Joining me today is Vincent Randazzo, Head of Technical Research for CFRA Research. And today, Vincent and I will be talking about spotting important market bottoms. But before we get started, let me just offer a little disclaimer that this presentation is for informational purposes only and is not a recommendation to buy or sell securities or to engage in any investment activity. That said, let's go to the first slide. Obviously, investment strategists are going to be looking in some ways, starting off by looking at fundamentals and looking at prior bear markets. Well, looking at the 12 bear markets since the late 1940s, which is also as far back as headline CPI data extends, we see that of the 12 bear markets, 9 of them were accompanied by recessions, whereas 3 were not. The reason I break this up is because those that were associated with recessions ended up lasting longer and fell further than those bear markets that were not associated with recessions. So the 9 recessions since 1948 that were accompanied by bear markets lasted 15 months, and the average price decline was 35%, whereas bear markets without accompanying recessions were off an average of 28% and were in bear market mode for an average of only 6 months. In terms of trying to figure out how far down this market could actually go, the far right-hand column shows by how much the market experienced a PE contraction during this bear market. During bear markets with recessions, the average was a 32% decline, whereas bear markets without recessions, interestingly enough, the average was 35%, primarily influenced by the crash of 1987. So if we were to apply this PE contraction of 32% to today's market environment, because there is a likelihood that we will see a recession sometime in the next year or so, the implication would be that the 23 PE experienced by the end of 2021 on a trailing basis would end up becoming a PE of 15 by the time this bear market ends. The real question is, what will earnings be at that point in time? If we were looking at PE or earnings estimates today, 15 months out, well, then what we would find is that the S&P would be trading around 3,500, maybe 3,450. But if we do find that earnings come down over that time frame, the multiple of 15 would then be applied against a smaller earnings base, and therefore the bottom could be even lower. So keep in mind that we traditionally see about 1/3 of the high PE be trimmed during a bear market. Another indicator is seen on the next slide, one that is fairly familiar to a lot of people, whether they are technicians, fundamentalists, etc. These are Fibonacci retracement levels. And the shaded line we see is the S&P 500. Above that are the 11 sectors within the 500, and below that are the growth and value groupings. The index level is where we were on May 19th. The recent high was where we were on January 3rd. And then the specific Fibonacci retracement levels, 23.6%, 38.2%, 50%, and then finally 61.8%, give us ideas as to how far down the market could go. Well, we've certainly gone well past the 23.6% level at 41.93. We are now challenging the 38.2% level at 38.19. If this is reached and that's all we experience, well, then we fell into the shallowest of bear markets, down only 20.4%. However, if you then overlay it with what I just mentioned in terms of fundamental forecasts, a more likely level would be the 35.17 Fibonacci retracement, which would be a bear market that is close to 27%. If, however, we do get earnings reductions along the way and apply that PE of 15 times, then maybe we do fall by 33%, which would be similar to what we experienced back in 2020. So sort of a moving target, but gives us an idea, in a sense, as to how far we can go. The next slide, however, does give us sort of an idea of a capitulation that we could experience. What I'm showing here is every one of these points is a intraday high-low percent, meaning what is the percentage differential between the S&P 500 high for the day and low for the day. And then I'm printing out the 15-day average. We see 2 standard deviations above, we see 1 standard deviation above, as well as 1 standard deviation below. So if you're at 1 standard deviation below, that means things are very quiet. And in a sense, investors are pretty complacent. When we move above 1 standard deviation, that's usually occurring when we're in a deep pullback or a correction. And as you can see with the arrow on the far right-hand side, where we are today is between 1 and 2 standard deviations, because we've experienced a decline of 18.7% for the S&P 500 on a closing basis. So that puts us squarely into correction mode, but not bear market mode. When you move above the 2 standard deviation level, however, that means panic has really started to set in. And what you look for is a peak like a stalagmite. And once it starts to decline, then typically we find that the worst is behind us and that peak is within approximately 1 month of the ultimate bear market bottom. That's pretty close when you look to 82, 87, 98, 02, etc. You might say, however, that, gee, it really missed the mark back in 2008. But not so, because while the peak was reached on October 31st of 08, most individual stocks within the S&P 500 posted bottoms in the latter part of November of 2008. It was the larger cap tech companies, financial companies, etc., that ended up dragging the index to its ultimate bottom on March 9th of 2009. But if you look to a majority of individual issues, their low point was in the latter part of November. Obviously, none of these 3 slides is a pure pinpointing of the decline. And you might also be wondering, why is a strategist talking about technicals? Well, I'm a big believer that prices lead fundamentals. And knowing that, I do dabble with technical analysis. But at this point, it's probably better to hear from somebody who is a true professional in technical analysis. So with that, I will turn it over to Vincent Randazzo.
Thank you, Sam. That was a really interesting set of information. I really do like that approach. Obviously tilted a little bit more my direction. You did say something that was, I think, a great lead-in to the Lowry analysis, our version of analysis. This is going to be a presentation for my part that you're not going to hear me talk about any price levels as a technician. And the reason is that just as Sam says, you know, price leads fundamentals. The indicators that the Lowry analysis uses are the indicators that lead price. So we sort of head out that equation and get there to that conclusion earlier. So we can see in a lot of our data on the next slide, we're going to get to in a minute, that the weakening in the market was actually apparent well before the top in January. But for right now, it feels a lot like the kids in the car ride when we're saying, you know, are we there yet, right? And I think that the answer, when you look at the data, the information, and you compare it to history, is that no, there's not a really high probability chance that we are there yet. I wouldn't speak that way to children, but be that as it may, here's what we have. If you look at these 2 indicators that we have in the bottom panes of this chart, which is the percent of New York Stock Exchange issues above their 10, and then below that, 30-week moving averages. In other words, what we're trying to identify is how many stocks are actually in medium to long-term uptrends. So if we're talking about a bull market, these numbers should be very high. They should be consistent and relatively stable. What we've seen since about June of last year was that these numbers were deteriorating. And typically, unfortunately, bottoms do not occur in these figures until they're in their teens. So right now, just to give you a sense for that, both of these numbers are around 35%. In other words, 35% of stocks are above their 10-week moving averages, and about 35% of stocks are in there above their 30-week moving averages. Now, I drew in a light green line that denotes where major bottoms, at least over the last 15 years or so, have occurred in these indicators. And you can see there's a lot of consistency in terms of absolute bottoms being formed in that zone under about 15 or 20%. The other thing that we look at, and it's one of the indicators we'll talk about on the next screen, is the average power rating. So Lowry has something called the average power rating index, or APR index, which is basically a great measure for breadth and demand intensity, because what we're doing is we're taking the 3,550 stocks in our database and we're giving a demand score for them on a uniform basis on a scale of 1 to 99. And typically what we found through history, and again, we've been around doing this since 1938, is that market bottoms tend to form when that indicator is below about 30. Of course, right now, we'll see on the next page, nowhere close to that right now. Also, the short-term index, which is Lowry's measure of short-term investor demand, tends to bottom out as far as coincide with major market bottoms below the 60 number. So that number, just to give you a sense, is around 80 right now, and it never reached below 64 on the mid-May low. So again, what we saw into mid-May is not consistent on any of these indicators with a durable bottom. If we look on the next page, we can see what we actually do have, which is that the indicators reflect an ongoing intermediate term downtrend. So again, getting back to this idea that we're not there yet. The good news is that we're getting there. So if you look at the, for example, the percent of stocks above their 30-week moving averages, that number, again, it's gone from 80 on the last slide, above 80, down into the 30s, on our way, right? So with these indicators, we look and we can see there are very clear downtrends in place. The first indicator in the middle pane here is the net percent spread between Lowry's buying power and selling pressure indexes. Now, these are just what they sound like, a measure of investor demand and investor supply. And really, the line is just the net difference between the two, just to make it easy. So we can see when this line is in a downtrend, as it has been since at least last summer, then you have difficult and increasingly difficult investing environment. So it's harder to be a stock picker, it's harder to pick the right sector, and it's just more difficult to make money. And of course, the more negative slope that line has, the worse off you are. And we can see we're still in a downtrend despite the fact that we did challenge it on this relief rally in the last couple of weeks, but that also looks like it's fading. So any kind of stabilization that we do see in that battleground between buyers and sellers, that needs to see upside follow through to a degree that would not be refutable in this case. So it's not necessarily an oversold indicator in this case, but you just want to break that trend to the upside. Now, I mentioned average power rating earlier. This is very clearly entrenched in a long-term downtrend. And when I said that our indicators lead price, you can again see that illustrated in these downtrends that have both been in place on this chart since about June of last year or July of last year. And this all suggests that we have the greater risk right now remains to the downside, not to the upside. So if that's the case, it's better to wait for the evidence to accumulate before taking action rather than becoming impatient, looking for a bottom, wishing for a bottom, and making that commitment too early. That's all from my perspective. I'm going to hand it back to Sam, who's going to tell us a little bit more about where to find our more information on our analysis.
Thank you, Vincent. Let's take a look at where investors can go to learn more about CFRA in general, as well as specifically about Lowry Research. Just go to CFRAresearch.com. That way you can learn about the CFRA research, whether it's forensic accounting, whether it's the typical wealth management information. Also, our Washington Associates, which looks at political analysis, and then finally, Lowry Research. For those who are familiar with our MarketScope Advisor platform and want to test it out, we do offer a free trial. So by going to advisor.marketscope.com, you can get more information and get a free trial to that platform. Ditto for Lowry Research. Clicking on the link to Lowry Research, once you get to the CFRA research slide, will give you an opportunity to test the waters. So thank you very much for tuning in. Thank you for listening. This was our attempt at giving you an idea as to what to look for to see when the bottom is near. But obviously the best thing to do is to monitor what CFRA has to say from both a fundamental and a technical perspective by coming back and looking at our research on a daily basis. Thank you, Vincent.
Thank you, Sam.